This is Fergus Hodgson. I am Director of Econ Americas, your home for financial freedom. And I'm just so privileged today to be speaking with Demelza Hays. She is the crypto PhD, or the lady famously known as the crypto economist, and it's on X at crypto PhD. She's worn many hats in this field over the years, and she works with a fund in Switzerland. She has a private mastermind group, and she has a newsletter which has been intermittent but is back rolling. And let me get this right, it's just cryptoresearch.report. If you want to sign up for that, it's going up monthly at the moment. And she is one of my real go-to people for this field of cryptocurrency that I've had curiosity about for a long time, but have not really been so engaged with in recent times. Now, Demelza, as people who are seeking to, let's say, get out of conventional stocks and bonds and to also protect against inflation, is cryptocurrency really a vehicle for that these days? Has the original, let's say, idea of circumventing central banks been lost? Is it just an institutionalized domain now?
Thank you. Let me start by saying thank you for having me on the show, Fergus. I appreciate it. I've known you for a long time, and it's always a pleasure to have these talks together. And if for anyone that's looking for the numbers for the answer to the question that you just asked, you can go to cryptoresearch.report. I recently, actually yesterday, published a whole article looking at what happened historically to an investor's portfolio if they added Bitcoin. So, for example, I took a balanced portfolio, 60% stocks, 40% bonds, and I added 5% of Bitcoin with quarterly rebalancing. So, basically every time Bitcoin started to run, you sold off your gains, you went back into stocks and bonds. And I did that from 2014 until September of this year, because I presented this analysis at a conference in Zurich recently. And it incredibly helped the portfolio's return over that time. So overall, the cumulative return, the total return for a stock and bond portfolio over the last decade was about 100%. I can check the exact numbers, but about 100%. 5% allocation to Bitcoin, quarterly rebalanced, doubled the return, and even more actually, to over 230% total return. So investors got a doubling of their return over the last decade if they had put just 5% into Bitcoin. So, in terms of, yes, it is still a risky investment. That is why most asset managers and let's say portfolio managers that are in this space, they would say, only invest a few percentage points of your total portfolio into this asset class, because if the entire position goes to zero, you only lose 5%. On the other hand, if Bitcoin continues to have the compound average growth rate that it has had, your portfolio will significantly outperform a normal stock and bond. But it's not only the outperformance, it's also the risk adjusted return. So the Sharpe ratio will be much better because Bitcoin has been uncorrelated with other asset classes like stocks and bonds and real estate and gold. So when you actually look at the maximum drawdown, the Sharpe ratio, you have a better overall risk adjusted return.
The one of the reasons why I became skeptical of this, Demelza, and you just referred to Bitcoin, so obviously there's a huge mosaic of other things going on beyond that, but is just that I personally, from the get-go, tried to use Bitcoin for transactions, international, what have you, and found it to be, let's say, less convenient than just using, what would it be, let's say TransferWise or Wise now, or was it Western Union, or these various international payments providers. And of course, then I would have problems when the locals would try to convert into whatever they needed to buy, that whatever they were using, wherever they were based. So I became a little bit concerned initially about their scalability and speed, all these practical concerns. And so why is it then? Why have we seen this tremendous move or shift towards the sector when, and let me just give you a couple of numbers here to play with. That if you just do a search about market cap, that cryptocurrencies have gone up by something like 60% market cap this year, depending on how how deep you go into various cryptocurrencies. But it's the pace has not slowed down, or at least it's going strong this year, despite whatever quote unquote crypto crash occurred a couple of weeks ago. But if you look to actual use for transactions, that is much more cryptic. It's much more difficult to get a sense for. So why do you think we are seeing this massive or just continued rise or interest in the sector in spite of maybe not as clear transaction cases? And a prominent monetary economist, which I assume you're familiar with, is Steve Hanke, and he just rips into these things all the time as some kind of Ponzi scheme. Well, not Ponzi scheme is the wrong word, some kind of bubble, right? And why do you think the interest has grown while the use cases have not been so explicit or clear? Or just because those cases have changed over time?
Okay, so great questions, great points. You're right. So the compound average growth rate for Bitcoin over the last decade has been about 55%. So it's definitely had a high return. It's attracted a lot of people. One of the original use cases that was touted for Bitcoin was being an electronic cash, right? A digital cash. That argument comes down to an old discussion that's been going on since the 1970s about whether gold is money or not. Okay. And if you're familiar with the Mises Institute, you've got all the gold is money proponents like Salerno and Murphy, and you've got Hulsman, and you've got everybody on that side that says gold is money. My uncle, who was also a fellow at the Mises Institute, Larry Seacrest, he came from the other side, which was saying that gold is not money. And he wrote a book called Free Banking. And his main argument was that gold has long-term stability, but not short-term stability, right? And I've expanded this argument in my own work because one of the main purposes of prices is to be a conduit of information that connects producers with demand, right? With consumer demand. So for example, if a producer sees, he's producing milk and he sees the price of milk go up, he has to figure out if that's due to additional consumer demand for milk or if that's due to something that's happening to the currency unit that the milk is priced in, right? So for example, let's say that he imagines that the price of milk going up means that the demand for milk has gone up. So he goes and he takes some of his surplus savings, his capital, and he invests it in production of more milk. He hires more farmhands, he gets more cattle, buys hay, whatever. Then it turns out at the end of the year's production that the milk price had increased due to inflation in the currency unit that milk was priced in and not due to actual increase in demand, right, for milk. And this is how we have misallocation of capital when we have a unit of account that is fluctuating all the time. So, in order to be the least noisy signal that matches all of the producers of a product with all of the consumers, we need that unit of account to be as stable as possible. Okay. And that's what will lead to better allocation of capital within the economy, right? Now, the issue is with gold, according to my uncle's research on different periods when there were regions that had gold standards. He argues that there was short-term price fluctuations in gold, and this could be due, for example, to the physical nature of gold. Larry White and George Selgin have also written on this topic. One point I made, I was at the Mises Institute as a fellow many years ago, and I love the Mises Institute. I donate to them. I love them. They're great people. They changed my life. Okay, I can't say thank you enough to them. But I had the pleasure of sitting down next to Lou Rockwell at lunch one day, and he was talking about how uh, Venezuela was having a problem with their currency and how gold would fix all of those problems. And I said to Lou, which I was very like nervous to speak directly to him. I said to him, uh, why don't Venezuelans adopt gold if gold is money? Why do we see them adopting the dollar, right?
I'll pick up that point from Demelza in case people are confused about how we define money, right? So, in the basic economic theory, we say that Money is a store of value, unit of count, and medium of exchange. And of course, what she's getting at is that gold, just given practicality challenges, is not that great medium of exchange, right?
Exactly, that's the point. So basically, gold is a great store of value, and Hayek has done historical research on basically showing that certain civilizations had two forms of money. One was the store of value, and then one was the transactional medium of exchange. And I'm also happy to share those if you keep notes for these videos. But basically, my uncle was coming from that side. And when Bitcoin came out, I argued against all of the Bitcoiners and said, no, we don't want to spend Bitcoin on a coffee. This is the most valuable asset our generation has ever seen, that the world has ever seen. And therefore, what you want to do is hold. You want to hoard. You want to accumulate Bitcoin. You don't want to spend your Bitcoin. And that is it's a new store of value. It's a new gold. Roger Ver and proponents of Bitcoin Cash and proponents of people that say Bitcoin should be used to buy coffee, they basically need transaction fees to come down a lot, right? Because it doesn't make sense to buy your coffee with Bitcoin when the fees are, more than the cost of the coffee, right? Different cryptocurrencies have come out that are faster, um, cheaper to use, like for example, Ethereum, or even the coin that Roger Ver supported, Bitcoin Cash, which was a fork of Bitcoin. We what we see empirically, which is a fact, is that people also don't use Ethereum to buy coffee. They don't use Bitcoin Cash to buy coffee. They don't use Solana to buy coffee. What they're using to transact with are stable coins. So these are coins that are backed by US dollars that run on the blockchain rails. Okay, so what do people want to spend? They want to spend money that's going to be debased, which is fiat. But what they want to hold is money that's scarce, which is gold and Bitcoin, right? So where I see us going is a world where we have Bitcoin, we have gold, and then we've got stable coins that are running on cheaper, faster blockchain rails like Ethereum, like Solana. But people are, transacting in a fiat that's being debased, and they don't want to store it. They just want to spend it.
The 2022 trucker convoy showed many Canadians had reached their limits. The convoy's participants encountered persecution from Ottawa and wondered what to do next. Financial Sovereignty for Canadians assists those looking to take direct action, and it outlines practical strategies. These include wealth protection with precious metals, the swiftest path to the United States, expatriation options in the Americas, censorship-resistant cryptocurrencies, and even the case for provincial independence from Ottawa. This book is a gateway to reclaiming your sovereignty, to being an economic driver and not a passenger. Buy it on Amazon.ca or click the link below.
There's a term in economics, I'll look this up for the show notes, that refers to the absence. Once some, let's say, inferior quality money enters the market, people will use that for transactions and, as you say, hoard the stronger or sounder money. Now, but there's a little bit of a question remaining there, Demelza, right? Because, and this is one point which an old friend of mine, Sven Larsen, wrote about recently, was just that there is some industrial use for gold, or ornamental use, or whatever. There are practical uses. Is there such a corresponding case for these cryptocurrencies or Bitcoin, right?
So I love that question too. It when I was at the Mises Institute, I was trying to answer that question as well, because it goes back to Mises's regression theorem, right? And how gold eventually became a global, let's say, monetary asset. I could not square that circle back in 2014 when I was at the Mises Institute. It was a very hard topic to try to explain why Bitcoin has value. What different analysts have come up with, for example, like, well, analysts, but researchers like Saifedean Amos, who wrote the Bitcoin Standard, he actually kind of turns it on its head and goes against, let's say, the regression theorem. And he basically says that actually having an industrial use is actually not, number one, it's not a requirement, but also it's not beneficial. So he wants to actually have a pure store of value that has no other use cases, and the subjective value of people in society is what gives that store value
Wow.
value. So it actually completely,
Yeah.
and I still don't have a good personal answer for that. But what I can say is that I personally highly value Bitcoin. I value it more than any other asset. So for me, every time Bitcoin's price drops, it's a buying opportunity because for me, it's the most valuable asset.
Wow. Okay. Yeah. I'm just going to share a note from Sven. He said, "Yeah, Bitcoin is 100% synthetic, and its value depends entirely on investors expecting future buyers to come their way." Right. So there is no economic activity that can substantiate future price increases because, I mean, the most fundamental, let's say, doctrine, you might say, of asset valuation is the present value or the net present value of future returns. And of course, it's really difficult to apply this to cryptocurrencies. So, and he claims, and I just don't know how to answer these questions, to be frank. He claims that Bitcoin has probably reached its all-out cap and the price rally is over. On what basis would someone make such a claim that this run is coming to an end? It just seems like more institutions are piling into this.
Oh, definitely. I mean, we've seen massive inflows. So October 5th was the day that there was a 20 billion dollar liquidation in crypto. The week prior to that, so leading up to October 5th, was the largest inflow week for the BlackRock IBIT Bitcoin ETF of 2025. So there are billions piling into for example, right now, and I track for the fund that I manage, I track all of the Bitcoin purchases and I compare it to the amount that's being supplied every day just to see the supply and demand for Bitcoin. So, for example, in 2025, the Bitcoin ETFs bought on average 1,000 Bitcoin per day. Every day, there's only 450 Bitcoin being created. Okay, but that's not all. I feel like a late night infomercial.
That is only the ETF consumption. Yeah.
Exactly. And who's buying even more than the ETFs are the digital asset treasury companies like MicroStrategy, MetaPlanet. I'm invested in one called Kindly MD/Nakamoto. Naka is the ticker. All of these ones bought on average 1,755 Bitcoin per day in 2025. So just known corporates and ETFs in America bought 2,700 Bitcoin per day on average. That does not take into consideration sovereigns buying Bitcoin, individuals buying Bitcoin. That's just literally the large counterparties where we can see on their quarterly filing statements that they've bought Bitcoin. So I would say that, I would not bet against the Bitcoin trend. However, there are lots of risks with Bitcoin that people should consider before making an allocation. So what I always tell people, like for example, I work for Zeltner Co, which is a Swiss asset manager. We have about 700 Bitcoin invested with us, and then we have our altcoin portfolio as well. So we're managing roughly 90 million in assets right now. And I get questions all the time from investors because I'm constantly talking to investors about our two AMCs. And I get questions like, Demelza, who made Bitcoin? And even actually a couple nights ago, Tucker Carlson, I don't know if you follow Tucker Carlson at all, but
It's a great topic. It's a
it
great
is,
topic. Yeah,
it
yeah,
is.
go ahead.
But for example, Tucker Carlson just recently, he was speaking at an event for Turning Point, and he said, "I'll never buy Bitcoin because I don't know who made it." Here's the thing: I've been in Chatham House meetings where we're not allowed to disclose what stuff has been said. I've been to Chatham meetings at Wharton with the SEC, with everybody. I have had a very key and prominent person that everyone knows. He's used to be in a very important political position. He told me that if he knew who Satoshi Nakamoto was, he would have had him arrested. Okay, so the reason we don't know who Satoshi Nakamoto was is because people that made stuff like the Liberty Dollar and other Bitcoin-like assets before Bitcoin came out got arrested for doing what they did, right? So whoever made Bitcoin, it could be the CIA, it could be the government.
It does seem that way. That seems like the preponderance of evidence at this point, but yeah. Maybe it was just kind of like a group of these people who are defying orders. Who knows?
Yeah, well, even if it is, it's an open source software, right? And so it's being hacked all the time. Every day there's people trying to hack Satoshi's wallets, which are now worth like over $130 billion, right? So there are people that are trying to hack this. They have not been able to hack it. I would say that if risks like this, like quantum computing or who made this, is it CIA? If those risks are important to an investor, then that's why you limit the allocation to 2%, 3% of your portfolio, right? But it doesn't mean you want a 0% allocation, because so far it has every year grown. I mean, it is growing in adoption, it's growing in market cap. And just because people aren't using it for coffee, it doesn't mean they're not using it at all.
People may not be using it for coffee, but so I guess, gosh, Demelza, there's so many directions I want to take this chat, but is it? But when you say this gentleman who's a political power broker or gatekeeper, this gentleman would want to prosecute or assassinate or whatever, harm anyone who created Bitcoin. Do you think that disruptive force is still at play, or is that really being led by altcoins now?
So I think now the US government has figured out that their way to stay the world reserve asset and to get out of their debt is through Bitcoin and stablecoins. So the US government is now going to support crypto. And maybe that's why, maybe they made it originally because they knew this was the end game. I don't think the government's that smart, but they do now notice, they do now realize that the way out of their 35 trillion or whatever the number is now debt is through Bitcoin. So for example, right now, the fifth largest treasury buyer of US government treasuries is Tether, the company that creates the USDT stablecoin. All right. So what's going to happen over the next decade is that every country that has a currency that is more inflationary or devalued more than the US dollar, all of those people in that country are going to flock to Tether. They're going to flock to the USDC Circle stablecoin. They are going to hold US dollars with stablecoins that their government can't stop because it's a private wallet on their own account. They can memorize the seed. It can be in their brain, and they could have access to $1 million worth of stablecoins, which they can get on a plane and then sell in whatever country they go to. The US government is now going to be able to issue debt for another decade or two as they suck up the entire global savings pool, surplus savings of everyone in the world, in countries where the currency is worse than the dollar. Okay, that's that's gonna fuel the American government to issue more debt, grow more. Okay. Meanwhile, if they spend if they rebalance gold, or if they find a budget neutral way to buy Bitcoin, meanwhile Bitcoin will continue to grow, and eventually they can get to the point where they can pay off their debt with their Bitcoin allocation. So for me, Bitcoin and stablecoins are gonna, let's say, save America. Now, what expense that comes at for the world is probably a huge debt blow up that takes out everyone in 15 years.
It is ironic that it almost seems to be going in the opposite direction, as you say, because the more that stablecoins denominate themselves in US dollars or back themselves with US dollars or treasuries, as you refer to, the more they basically strengthen the US federal government's position. It is bizarre. Yeah. So it is almost flipped.
Yeah, there's about 300 billion in stablecoin issuance right now. So a year ago there was 200 billion. We're issued 100 billion more this year in stablecoin issuance. So that's growing faster than the ETFs. Stablecoin issuance is growing so fast. And I actually know somebody from Turkey that was able to get all of their wealth out of Turkey by using a US dollars backed stablecoin, and then moving to another country and selling that for some other stuff in that country. So it's got a huge use case.
So is that really where the innovation is going on now, building stable coins? Now, are there any that are brave enough to align themselves with the Swiss franc or whatever it may be?
So there are coins like Frankencoin and different stable coins that are linked to the Swiss franc. But where a lot of the demand is, I would say, is in the US dollar. Like there have been different stable coins that have tried to be backed, pegged to the euro or pegged to other currencies, but the US dollar has been the one that's attracted, like, I could look at the exact numbers, but I would guess it's probably 90% of global stablecoin issuance is with the US dollar. And that when you actually look at the chart of transactions per day, right? Like you said earlier, Bitcoin does not have many transactions per day. But Solana, Ethereum, Tron, different rail blockchains that provide the rails for stablecoins are where we're getting tons of activity. So, for example, the majority of stablecoins are issued on Ethereum, but that is changing now. So Tron has really grown a lot for especially Tether, and we also see that, for example, number of transactions on chain is highest on Solana. So we I think a lot of the innovation is coming around stablecoins, and I would say the other main area where investors constantly ask me, Demelza, how can I gain exposure? It's real world asset tokenization. And that's a huge word and it sounds overwhelming. But the idea of it is that instead of trading stock, GameStop stock or Tesla stock or whatever stock on NASDAQ or the New York Stock Exchange via your brokerage like Fidelity or Vanguard, you would instead have a wallet on your browser, and that wallet would have Ethereum or Solana in it, and you could buy a stock with your browser wallet. You would be the custodian of that stock. No DTCC clearinghouse in New Jersey would be holding that stock. You would be the custodian. It would become a bearer instrument again. You would have, yeah, you would have that in your possession, right? So that is the other area we're going. That's where, for example, BlackRock tokenized a money market mutual fund. They built it on Ethereum and Stellar, and then Franklin Templeton launched a very similar product as a competitor. And they've also expanded it to Solana, and it's across blockchains right now. But those money market accounts, I believe, have close to 2 billion in assets that have been tokenized in the last 6 months or so. And and BlackRock, Larry Fink has said we are going to tokenize everything, right? So the direction is stablecoins, real world asset tokenization, and Bitcoin as a store of value. And then the question is, well, why does Bitcoin outperform these altcoins all the time? Like every year Bitcoin's crushing these altcoins. I think it comes down to the target addressable market for each use case, right? So Bitcoin has the target addressable market of gold, which is what, like, I don't know what it's at now, 25 trillion or something, I'm guessing somewhere around there. I'd guess it's like a couple months ago it was at 20 trillion before we had this hockey stick performance. But then we've got global M2, which could be, let's put some of that as a store value. We've got real estate. How many people bought a second home or investment property instead of because they wanted to get the money out of their bank account? They didn't want to have their money just debased every year, right? So how many people bought real estate because of a store value, looking for a store value? All of that is the target addressable market for Bitcoin. What is the target addressable market for stable coins? Probably looking at M2, 90 trillion globally. The US dollar makes up about 60 trillion of that. And then what you're talking about for real world asset tokenization is not the value of the stocks. Not, for example, if you added up GameStop's market cap and Tesla's market cap and you added up all that, that's not what is the target addressable market. It's the demand for the token. If every single time I want to buy a stock, I have to pay a transaction fee in this random altcoin. That's the value of that. So it's kind of like, what's the value of being the infrastructure to buy stocks and bonds and get paid your coupon rates and get paid your dividends and all of that kind of stuff. So it's a totally different target addressable market. And what I do, what makes the fund unique that I manage, I'm discretionary. So that means that it's not systematic. I don't have an algorithm. We have two products. One does have an algorithm. The second product is discretionary, where we're looking at on-chain and off-chain metrics, doing fundamental analysis, looking at what coins are actually being used, and then building our portfolio around that. So my focus has been exactly on this topic, which is, where do we see the innovation going?
Man, I could listen to this all day. It's great because there's just so much action in this space, and it really is exciting. And maybe it hasn't happened as quickly as many of us hoped for back in 2010 or whenever we learned about this. But maybe it's almost healthier that it's happening in a more gradual or kind of like a way that we can build an infrastructure around this new space and learn about it before too many bad actors derail this evolution. So okay, yeah, her website is cryptoresearch.report, and her X is a lovely crypto PhD. So follow her and get her report. And I'm actually going to go read this one, which came out 2 days ago apparently, and I was not aware of. So Demelza, it's wonderful to learn from you. Thanks for sharing your time.